Good afternoon, good evening. Welcome to another weekly Wednesday webinar. We're excited to have you join. Please, relax, get your water, get your dinner, and just spend the next hour with the USSFCU team. My name is Eddie Villanueva, and I'm your official MC, as Mr. Milton says, of the weekly Wednesday webinars. But we're so excited to, learn something new this evening. It's our IRA 101, how to get started and understand the basics. Many people, like me, before I started working at the credit union, I thought that you needed to be a little bit older to get an IRA, but in reality, anybody can open an IRA. But we're gonna go through those basics. We're gonna give you that information that you need to get started today. And I see many, many familiar names on the attendee list. One of them in particular is Gretchen. Gretchen, welcome
Gretchen.
to our weekly Wednesday webinar. Thank you for being here with us. We appreciate your support. For those that don't know, Gretchen is part of the marketing department, so thank you for joining us as well. And if you want to say hi on the comments on the chat, please, make sure you say hi to us. If you want to give us any feedback, we're always, open to hear those. And if you have any ideas for the weekly Wednesday webinars, please send them our way so that way we can improve your experience with us. Also, during the presentation, if you have any questions, any concerns, whether it's related to the topic or anything in general, please make sure that you use the chat feature to send your questions or the Q&A. And as we have a commitment every single week, Carrie, what's the commitment every single week with the questions?
To answer every single one until even if we got to be here till midnight. And
There we go.
last time Madison was here, I counted, I think we had 22 questions. So I hope we have as many this time. It's great questions.
All right. Last time was 22. This time, attendees and panelists, be ready. Maybe we can get to 40. We'll see. So, Madison, be ready to answer all of those questions.
I'm ready.
And with that being said, I don't want to, I want to spend any more time with the intro. I want to pass it on to our membership development officer, Milton Aguilar Bolanos, which will introduce everybody on the panelist team. Milton, take it away.
Hey Eddie, thank you so much. And as always, thank you to everyone who made some time out of their busy schedule and join us on another wonderful evening here at the weekly Wednesday webinar from the United States Senate Federal Credit Union. Again, we are really excited and delighted to have you join us. As Eddie alluded to, it's a great topic. It's IRA 101. I got my notebook ready. I feel like I'm going back to college. And it's all about IRAs. I know it's a hot topic, especially now that we are close to the big tax day, April 15, if I'm not mistaken, or 16.
Yep, it's the 15th this year.
Yeah, so I know, and for those that don't know much about IRA, or you already have a great knowledge about it, I'm sure Madison is going to tell us about how there always changes. It almost feels like every year there's always a change happening with IRA that are impacting IRA. So with that being said, I don't want to steal Madison's thunder. Let me go ahead and start with the intros. You already heard his voice, Mr. Villanueva, Mr. MC from the marketing team. Also from marketing, we have Andrea, who is going to be keeping track of the chat and the Q&A. So again, we invite you to be interactive throughout the presentation, and we do have the commitment. Eddie and already said it, and the commitment is that we will answer every question before we let you go this evening. Also, the person in charge, responsible for putting all this beautiful content that you will see in the presentation this evening, is our very own Carrie Lazar from the marketing department as well, and the expert for this evening. You know what? I don't want to say she is a guest a presenter. I feel like she should be part of the weekly Wednesday webinar team. I mean, she has come in into many webinars by now, and it's starting to become a familiar face here with everyone. So. But with that being said, again, we want to give a warm welcome to our Madison Love, who is the IRA manager for the credit union, has a little over 10 years of experience with IRAs, and she's gonna enlighten us with a lot more information on IRA. So with that being said, Madison, take it away.
Thank you so much. Yeah, thanks for that introduction. I really love these webinars. I think that they are so valuable. And also, just as a little um, nod to them as well, is that you can see all of the past ones. So I've already done one IRA webinar, and then I'm going to do a couple more. But any topic that you guys want, they've covered, and they're so fantastic. Like they said, I join even when they're not mine, and so please know that that's always a resource available to you. You can send them to people that you love, all of that good stuff. So with that being said, let's get into today's topic. So we're going to go over understanding IRAs and why they matter. We're going to talk about the different types of IRAs and their various benefits. We're going to go over key rules and terminology. I'm really excited about that one. I think knowing the terminology can really, really help you and take away some of that intimidation factor. And then we're also going to talk about how to open your IRA and maximize your IRA. And then like they said, Q&A at the end, you do not need to get 40, but I will be here if you do. All right, so we're going to start with the definition. Always a good place to start. At a financial institution, IRA stands for Individual Retirement Account. So I do want to hit on individual a little bit. Sometimes I'm also throughout this presentation going to talk about common mistakes or points of confusion that I see in the industry. So with individual retirement account, the account is a tax advantage savings account designed to help you save for retirement. But hitting on that word individual, a lot of times members will want their spouse on their account, or if they have a child that's on all their other accounts, they want to put them on their IRA as well. And people get confused. We cannot do that. An IRA can only be in your name. So how we make sure that your loved ones have access to these accounts in the event that you pass away is through beneficiaries. So the other piece of that is that if you, let's say at USSFCU, you and your spouse have an account, but you're not the primary, your spouse is, you would need to open up your own account in order to have an IRA on it. Now, your spouse who's the primary, even though you're on the account, they can still open up that IRA on that account, but you would not have access to their IRA still. So in order to have an IRA at a financial institution, you need to be the primary of the account, and you are going to be the only person on that account. So just some things that I see a lot to hopefully wipe that confusion out. But the purpose of an IRA is really it helps you grow your retirement savings. Most people are not going to be able to live on their Social Security alone, or for people who have circumstances where their Social Security might not be very good, retirement's all the more important. So I feel passionately that everybody needs a retirement account. And then there are tax benefits to entice you to save. And some of those are really, really good and really, really helpful. Especially while you're saving. And then it's available to individuals, not just through your employer. So if you have a unique work situation, even if you have a mainstream job, you have that 401k, there is still room for an IRA in your life. Let's talk about the tax advantages first, and why, we're going to talk about why to save with an IRA. That first line there is tax advantages that help your money grow faster. So there's a few tax advantages. The most common ones are with like a traditional IRA and Roth, and we're going to get into those types of IRAs in a minute. But you can either have a tax break when you're contributing the money with a traditional, or you can get a tax break when you're distributing the money with a Roth. We're also going to go briefly, very, very surface level with SEP IRAs and simple IRAs. Are you guys still there?
Oh, yes, but I think we lost your screen. You might have to restart again.
Thank you. Sorry,
You
my
scared?
internet, I guess, just wasn't as happy with me. Um, let
We had
me,
a little bit of a network issue here in Madison. I think it's everyone impacting everyone, but
okay.
we apologize to everyone. Trying to get it back here very soon.
Yeah. Let me see here. Okay, so I don't have a share my screen option anymore. Do any of you guys, any of my fellow presenters, are either?
Give us a second. We'll go ahead and make you co-host again, and I believe that's what we need to do. So, Karen,
She's still co-host. I'm going to withdraw your permissions and try again.
Okay,
okay.
sounds good. Thank you.
Again, everyone, our apologies. We are, I believe this is the first time that this has happened to us, so we do apologize. But this is the risk that we take when we do these presentations live. So it just goes to show you that everything that we do here is organic, and the presentation is live. So again, hang tight with us for a couple of minutes, and I believe if you have any questions or concerns, please feel free to use the chat feature or the Q&A, and we're getting back on the screen. So, and that's my German Shepherd, by the way, saying hi to everyone. He hasn't say hello to you all in a while.
Madison,
Okay,
oh, perfect. I see your screen.
great.
Okay.
All right. Okay, yeah, sorry about that. So we'll just get right back into it. So yes, we were talking about tax advantages. So the typical ones with trads and Roths, and then SEPs and Simples also have tax advantages for business owners. So we'll get into that just a smidgen when we talk about those. And then another really cool thing is, and I won't go too much into it because I'm not a tax advisor, and so I can't actually advise on like the rules and things around that. But there is a tax savers credit, and if you qualify, that first $2,000 that you're putting into your IRA, you can get up to 50% of that back. So, and that's true for both a Roth and traditional, for sure. So, there are ways to get to really make these investments stretch so that you're earning the most bang for your buck. So, and then another reason to save with an IRA is that you just get additional savings beyond your 401k or pension. I'm a big fan of the match and out approach. So when you have a 401k, a lot of times your company will offer a match. And that is anywhere between 3 and 5%. You typically, I always recommend to take full advantage of that. But then outside of that, you can still save in an IRA. And I always recommend to do that. You can save more in your 401k too. If you're blessed enough that you can max out your 401k, IRAs can provide you with an extra $7,000 or $8,000 that you can save towards retirement, which again, with time and investments can really add up to quite a bit. So, and then you also have more flexibility within your IRA to choose your investments. A lot of times with a 401k or other type of plan, you need to do what the company offers. And it's usually a pretty good offering. It's usually pretty run of the mill sometimes you can even choose like low risk, high risk, medium risk. But with an IRA, the world really is your oyster. So I know that a lot of I know that there's like alternative investments out there available to people. And so I've heard of people investing in really wild things. So things like Airbnbs and rental properties and all sorts of stuff. So really, really really cool options out there. Also like gold and things like that. But and then it can be opened at any time. So you're not required to be employed. It doesn't matter what your job situation is. If some people are employed part of the year while others are employed, the whole year or whatever. None of that matters with an IRA. You have full ability to have that IRA no matter what your employment is. And now you do have to have earned income to contribute, but that's the only caveat there. Okay, so, oops, sorry. Okay, there we go. So this is just the 4 types of IRAs that are most common, or that are available. That's the 4 IRAs. So there's that traditional and that again, we're going to go into each one of these individually, but traditional, its big claim to fame is that your investments can grow tax deferred, or sorry, your contribution. I got rattled by the thing going away. So anyway, with a traditional IRA, your initial contribution can be tax deferred, which if you're trying to avoid like a certain tax bracket, that's really beneficial. And then with the Roth, it's that your investments and your earnings can grow tax-free. So when you take out that distribution, it's already tax money that went in. So anything, if you do it right in the right way at the right time, then that can all come out tax-free, which is really exciting. And then a SEP IRA is for self-employed individuals and small businesses. A SEP IRA is particularly valuable to like to the self-employed, and if you are like a family-run company, and I'll get more into those reasons as to why and when we talk about SEPs and simples. And then a simple IRA is great for small businesses. So so these are kind of your options, and then each one of them have their own eligibility rules and tax implications and fees and all that other stuff. So it is really valuable to know what you're doing when you are when you get one of these. And so I think you're all incredibly wise to be here at this training and to absorb other content when you can. So also always talk to a tax advisor. They're available to you, or a financial advisor. They're also great for this kind of thing. So let's get into the more nitty gritty with the traditional IRA. So contributions may be tax deductible, tax deferred growth. So everything in there is growing. So if your IRA makes $10,000 in a year, that is not going to count as earned income until you take that out. So that's another reason to be investing within your IRA instead of investing like just on your own, is that if you make $10,000 in a year, with your investments and it's outside of an IRA, that's going to count as income, whereas in the IRA, you're protected a little bit more. Depending on how you look at it. A downside is that you do need to start taking required minimum distributions, or RMDs, starting at age 73. This has changed in the past. So it's been 73 for a little while now, but it does go up as like life expectancy goes up. So that's something that can potentially change. But as of right now, it's 73. I do think that they have plans in the next few years to go up to 75. But and then early withdrawals before age 59 may be subject to penalties. So with a traditional IRA, no matter what, if you take money out, you're going to be taxed because you never paid taxes on it. But if it's before 59 and a half, a lot of times there are penalties as well. We're going to get into exceptions in a minute. All right, so then a Roth IRA, just a little personal note, Roth IRAs are by far my favorite. I'm very, very biased, and I think for good reason. So Roth IRAs are great because you make contributions after tax. So that means that it's not going to affect your adjusted gross income, which this is the con, right? Like this was the pro with traditionals. With the Roth IRA, you don't get that benefit. So you're going to make contributions, and that is just off of the money that comes into your paycheck. You can set up like automatic contributions, but you're not going to get any benefit for contributing right now, other than that tax savers credit. But anyway, so you're going to contribute, and then everything that's in there, all of that investing, it grows tax-free. And so if you pull it out correctly after 59 and a half, and talk to a tax advisor before you pull money out to make sure you're not going to be penalized, but you do not need to pay taxes on those earnings. So that, especially if you're a little bit younger, or if you're intending on that investment being in there for a long time. So I know my father is in his 60s, and he just recently opened up a Roth IRA because he has no intentions of using it in the next 10, 15 years, because he has other resources for income in his retirement. And so even if you're not younger, this is still a great IRA as long as you're not intending to necessarily use it. If you are planning on using the money within the next 5 to 10 years, you're at the height of your career, you're in a yucky tax bracket, then by all means, the traditional is there for a reason, and it's a great IRA. But if that's not your situation, almost always a Roth IRA is better, in my opinion. But you should absolutely talk to somebody about um which one is right for you. And then the other nice thing about Roth IRAs is that there is no required minimum distribution ever. So because the government has already gotten their piece of the pie, they are not worried about when you take it out. With a traditional IRA, they want you to ultimately deplete it, so they can get their funds or their portion of it. With a Roth IRA, they're never going to get any taxes off of it again anyway. So you don't have to deplete it by a certain age. Again, that's another reason that my dad ended up going with a Roth IRA, is that that was a huge part of what he wanted to leave as an inheritance. And so this way he doesn't have to worry about withdrawing it if he doesn't need it. And then, but just like the traditional, early withdrawals before 59 and a half may be subject to penalties. So let's get into that. Sorry, I am showing you guys the wrong presentation. My goodness. Let me get the right one here. Okay, this is the right one. I am so sorry, everyone. Okay. Share. Okay,
There it goes.
there we go. Okay, so first and foremost, the best exception to use is if you're over age 59 and a half. And I'm not going to go into all the details of these, but that information is out there if you need it. Again, talk to a tax advisor before you ever take a withdrawal. And then death, your loved ones will be able to access the funds if that time comes. And then disability, IRS levy, and substantial equal periodic payments. Those are all going to be in extenuating circumstances. And then here are a few more. Medical expenses. That one has really been able to help a lot of people. A lot of these have been added recently. I know when I first entered IRAs, there was only like 5 reasons, and now we're getting a lot more. Because I know a big criticism of why people don't want to have an IRA and fund their IRA is that they are afraid that they'll never be able to get it out, or that it'll be so expensive to get it out. And so things like medical expenses, higher education, first-time home buying, those are absolutely reasons that you can access that money again without penalty. Again, you need to do it in the right way. You need to make sure you qualify, all of those good things, but don't let your fear of needing the money stop you from investing and saving for this retirement, because chances are you probably won't need it, but you are absolutely going to need to take care of yourself during retirement. And then also, if there's another way, I always encourage not taking money from your IRA, just because it is hard to get money in there. You are limited to a certain amount every year, things like that. So I'm certainly not recommending that you take money out, but if you are in a situation where you need your medical expenses covered and the interest rate is going to be more than what you can get in your investment, then by all means, please know that that's available to you. I know a big one for millennials right now is that first-time home buyer expenses. That one is really, really beneficial because you can take up to $10,000, and housing, nobody expected housing prices to skyrocket the way that they have. And this way, it might help you just get that little extra jump that you need in order to get into that first time home, which is an asset in and of itself, and helping you with your future as well. The other thing that I wanted to note was that higher education expenses do include your children. So if you are at a stage where you're sure that you're going to be covered for retirement and you want to help your children with higher education, that is an excellent resource as well. Okay, so let's talk about SEPs and simples a little bit. So with a SEP IRA, SEP IRAs have higher contribution limits they are funded by the employer and they can only be funded by the employer. Now, that employer can fund quite a bit if they choose. They're not limited to like a smaller amount. And so that's why I said earlier that SEP IRAs are typically better if you are a sole proprietorship, or if you're a one-man show, or if like it's a business with your family. A lot of times, because the way that you set up that IRA is how you can determine how much everybody's going to get, but typically it's going to be somewhat equal. So, so you might not want, I know like a lot of doctors end up, they think that SEP IRAs are the best, and then they don't want to give one of their employees, the same percentage that they're getting, or whatever the case may be. It just make sure it's the right one for you. A simple IRA is more like a traditional 401k. It's a little bit easier to set up than a 401k for a small company. You do have to have fewer than 100 employees. Now, and they are not simple. That is like the biggest misdirect that anybody's ever done. So they are fairly complex. So you definitely want to be working with somebody who really understands them before you go into that. But that's going to be better for, like I mentioned, like doctors who need to pay like a receptionist and a few other people, but they're not necessarily wanting to pay them what they're paying themselves for their retirement savings. And this option also has a match option, which is cool. So that way they can those employees can be contributing themselves as well. And it gives a little bit more power to them. So it really depends on what your situation is, what your business is, all of that good stuff. If you want to choose one of those. So let's go over some terminology. So first, I'm going to go over the word contribution. Contribution is the same as deposit. A contribution is what you are putting into the account, whether it's, by you or really anybody can contribute to your IRA. And then IRAs all have contribution limits. So there is a maximum amount that you can put in, and that depends on what type of IRA. So for Roth and traditional, that did stay the same as last year. This typically goes up. It's common for it to go up every year. It doesn't have to. It's also common for it to not go up from one year to the next. But this is something that is worth a quick Google January 1st of every year to make sure that you're contributing the most that you can. So right now it's at $7,000. Once you obtain the age of 50, you are allowed to do a catch-up contribution with Roth and traditional IRAs, and that's an extra $1,000. Other types of retirement accounts also have catch-up contributions, and those are at different ages and different amounts. So, but for Roth and traditional, so far it's always been $1,000, and it happens once you're 50. So that covers catch-up contributions, required minimum distributions or RMDs. Excuse me, that is what we were talking about with traditional IRAs. Again, that is only on traditional IRAs. I do want to say one thing about SEPs and simples. Those right now are considered traditional funds. So after 2 years, they can be transferred into a traditional IRA. And so that is potentially changing. And the IRS is currently working on a Roth option for that, but we aren't exactly sure when that's coming about. So that is in the future, but it's not now. But anyway, and so with traditional funds, you do have that RMD mandatory withdrawals starting at age 73. Early withdrawal penalties, really quick, a distribution and a withdrawal are the same thing. And early withdrawal penalties, there is a fee when you withdraw the funds before 59.5 if you do not have an exception. And that's typically 10% of the amount withdrawn. And then there's also sometimes taxes. And so you're going to want to talk to a tax advisor before incurring any of those penalties so that you can make sure that you know what they are and know that that's like worth it to you. I'm going to go into rollovers and transfers now, but I do want to just give it a little plug. I would say that this is like the most important terminology, or not the most important, the most commonly mistaken. So even like financial institutions won't use these correctly sometimes, but a rollover is when there's two types of rollovers. There's an indirect rollover and a direct rollover. But typically a rollover is the most common rollover. It's coming from a 401k and it's being rolled into an IRA. This has to be rolled into a like account. So if you have a traditional 401k, it needs to be rolled into a traditional IRA. If it is a Roth 401k, because those do exist, then it can be transferred into or it can be rolled over, sorry, it can be rolled over into a Roth IRA. So, and here's a good rule. If you're like, I don't know if my 401k is traditional or Roth, if you don't know, it's probably traditional. They are automatically set up to be traditional. And most of the time, even the employer's contribution, whether you switch it to a Roth or not, is going to be traditional. So you would need to go into first of all, your work would need to provide a Roth option, then you would need to go in and elect for it. And then you would still probably have traditional funds. So if you do not remember doing that, then it's traditional funds. Most 401ks are traditional. The other type of rollover is an indirect rollover, and that is where the funds were dispersed, whether it's from a 401k or a IRA, and they're given to you, the member, to hold on to for a time. You have up to 60 days to hold on to those funds before putting them back into an IRA for it to count as a rollover. You're only allowed to do one of those in a 12-month period. The main reason that you would want to do that is if you are wanting to do a transfer, but the institution isn't moving at your pace. You have a little bit more control over this. I don't typically recommend it. It's worth making the institutions do it, because then you don't have to worry about taxes or tax time. They're going to ask you about this rollover if you do an indirect rollover. It's a lot more streamlined and you're better taken care of with a transfer. But if you need that for some reason, that is available to you. So again, the most common rollover, so the rollover I'm going to focus on is that direct rollover. It's from a 401k to an IRA. A transfer is when you're moving funds from one IRA to another. And you can do that as often as you want because the government only sees you as having one IRA. So they don't care if it's at Fidelity or at USSFCU or at Bank of America, they don't care. So you can move it in between banks all you want. And that's primarily going to be to make sure that you're investing in what you want to be invested in. Okay. And then another common mistake that I've seen is that some institutions, specifically, I've noticed it with Fidelity. Fidelity is a great partner, and so I'm not trying to rag on them, but something that they'll do is if you had a 401k through Fidelity, and then you left that company, they'll change it to a rollover IRA is what they name it. That is their naming system. That does not mean that you need to roll it over. They already did the rollover. So from now on, you can just do transfers. So don't let that confuse you either. It's just their naming convention. It makes sense because they rolled it over for you. Now it's a rolled over IRA, rollover IRA. So it makes sense. It's just throwing that terminology around in a slightly confusing way. So I think I covered everything I wanted to do there. So next, we're going to talk about choosing the right IRA. So some things to consider: your income level and tax situation. So I mentioned earlier that I really, really prefer Roths. The caveat to Roth IRAs is that you do have to make below a certain amount. So they call it a MAGI, or maximum adjusted gross income. That amount is determined based on how you file your taxes, your adjusted gross income, all of that good stuff. So, and then there's phase out ranges. So you might be able to contribute $2,000 to a Roth IRA, and then the rest would have to be put into a traditional. There is a way around that. Excuse me. So you can open up a Roth IRA and then also a traditional. You can contribute to your traditional and then you can convert it. There are tax consequences with that. So make sure to talk to a financial advisor or tax advisor before you do that. Make sure that you understand that full process. But the point of today's session is just to make sure that you understand that even if you have too much money to contribute to, or too much income to contribute to a Roth, there are still ways to get you a Roth IRA if that's your goal. But if you like the traditional IRA, again, that's a huge reason that people have traditional IRAs, and it's a totally valid one. You also need to consider your retirement goals. How wealthy do you want to be in your retirement? Are you somebody, if you're somebody who wants to go and live off the grid and live off the land in your older age and have a really minimalistic lifestyle, that can be really beautiful and great. And so you probably don't need to save as much. Or you might want to save really aggressively and then decide to retire early. If you're somebody who wants to travel and see the world and spoil grandkids and whatever the case may be, then you might want to be a little bit more aggressive with your retirement goals. And an IRA can absolutely help you do that. And then obviously flexibility needs. We mentioned what you can take out for early and things like that. So yeah. So if you ever need help deciding which IRA, I can't give you advice, but I can talk about, in what situation I think is best. But also we have a financial advisor that we use. And I can always recommend you to them. And we also, if you have a trusted tax advisor, always recommend that. So now let's talk about how to open and fund an IRA. So first you need to pick which IRA that you want, traditional or Roth. And we kind of went through that pretty well. And so the next thing you need to do is you need to open an account at USSFCU. Another really common thing that I see, not just at our institution, all institutions, is that somebody will apply to open an IRA at USSFCU without establishing that relationship first. So you need to become a member first. You just need to have a savings account. If you don't want a checking or anything like that, you don't have to. We do have phenomenal checking accounts. We also have a really great credit card if you're looking for that. But, and so absolutely see if there's anything else about our credit union that benefits you. That's the whole point of a credit union, is that we're here to serve you in your unique circumstance. That's why the credit unions serve different people. So see if we can do anything else for you. But if all you're interested in is that IRA, that's great. Or if you already have an account at USSFCU, or if you're a secondary on an account, but you want to be a primary so you can open up that IRA, that's all good reasons. So you need to first establish that relationship with USSFCU, become a primary on an account, and then you can apply for an IRA. After that, you are going to be able to fund your IRA. There's quite a few ways to do that. You can do a lump sum contribution. So that's going to, let's say you decide to contribute $5,000. You can just write a check for $5,000. We'll put it in that IRA and then you're done. Again, you can go up to the max, or you can contribute a small amount, $2,000, get that tax savers credit, move on. Whatever you want to do. The next is automatic monthly contributions. These are my personal favorite way. This is how I contribute to my IRA. Just when I pay my bills, one of my bills that I consider a bill is contributing to my IRA. And that can be as smaller as, well, up to I think to hit your max, it's like 500 and some dollars. So anywhere between $1 and 500 and something odd dollars is great. No matter where you are in life, contributing something is better than nothing. So you can set that up with us, and we're so happy to help you with that. If you are not that interested in contributing new funds, or you're not qualified to contribute new funds, but you have a 401k somewhere, especially if you've just recently had a job change, something like that, rolling over your 401k is an excellent way to fund your IRA. There is not a strict timeline on funding your IRA. We know that it can take time. So if a rollover is going to take a little while, that's okay. Just let us know that you're intending for a rollover to come through. I'll show you the application form here in just a minute, and you can do it that way. With a 401k, with a rollover, you do need to initiate it with the other company. Whoever has the money starts with the rollover. And then an IRA to IRA transfer. IRA to IRA transfer is slightly different. Whoever gets the money requests the money. That's the other reason we really want you to know the difference between a rollover and a transfer, is that that determines who does what. So with a transfer, if you opened up your IRA at USSFCU and you want to transfer money in, you're going to call me up. I'm going to help you fill out that transfer paperwork. I'm going to send that transfer paperwork. And then we together might need to call or contact your other institution if we're not getting the money on your timetable, things like that. But generally, I and my team handles the IRA transfer start to finish. The tax deadline is April 15th this year. It is whatever the tax deadline is. Actually, I do have a little bit more to say about that. So we're just going to go back here really quick. So the deadline to contribute for 2024 is April 15th, 2025. So that means that you have until the tax deadline to contribute for 2024. So I'm going to give you a little insider tip, okay? So if you're wanting to open up a Roth IRA, before you can take money out without or before you can take earnings out without penalty and tax, it's easy. You need to fulfill a 5-year rule. So they want you to have your Roth IRA for 5 years before you start messing with taking stuff out. And there's exceptions, there's guidelines, there's rules. You should look that up. But the point is that you have a 5-year rule to open up a Roth IRA before you can start accessing that money in the best way. If you contribute today or before April 15th to a Roth IRA for prior year, then that clock starts January 1st of 2024. So you can open up a Roth IRA today or tomorrow or in 3 weeks, and your 5-year clock started January 1st of 2024. So you get a year for free. Just for these first 3 months. So that's my little insider tip. Now, if you have a Roth IRA anywhere, that 5-year clock starts. So if you already have a Roth IRA somewhere and you just want to open up one here to get into our CDs or whatever the case may be, then you don't need to worry about that 5-year clock. But if you're like, dang it, I forgot to contribute to my traditional IRA for 2024, it's not too late. Now, that April 15th deadline is really, really strict. We can't make exceptions. So get it in before April 15th and we'll make sure, and then make sure on that form that you indicate. And honestly, I always recommend to put it on the check too, in the memo, say prior year contribution 2024. That just makes sure that it gets where you want it to get. Okay, so I'm going to go over the application really, really quickly. I know a lot of people get intimidated by the application. You don't have to fill everything out. And also, we are so happy to help you fill it out. So that first section is your information. If you're not comfortable putting something on there, don't. We will fill it out. We have access to all of your information. And so like if you're nervous about putting your social security number on there, don't worry about it. We'll talk to you. We'll get it on there after it's been sent. We don't want to send any private information in any insecure way. So be cautious of that. But Part 2, Roth IRA custodian, that's us, that's your financial institution. So that's going to be the name is USSFCU. And again, we can help you fill that out. The next part is how are you going to contribute? So you can do you're going to put the contribution amount, the contribution date. So even if you're doing a prior year, you're going to put today's date. And then you're going to mark how you want to do this. Really, the first 3 are the most common. You really don't need to worry about the other ones. If you're doing one of the other ones, we're already talking. So, but regular rollover transfer, and then you can see that's where you can put prior year. Investment information. So you never want to open an IRA and put money into it and go to all that trouble and not invest it. So we offer savings accounts and CDs. We also, as I mentioned earlier, are connected to Fellows, a financial guide or investment specialist. And we work with Michael Shamel, and he has a lot more investment options. So if you want to get the money in with us, then we can connect you with him, and it can be great. But that first section with the lines, you can skip that. That's not for anything that we do. This is we get our forms from a form provider so that we can make sure that we're compliant and they're accurate. And so they have to have extra stuff in there that we don't need. So we also don't do external accounts. So it can be cash, check, or internal account. Beneficiaries, we do not need all of this information for your beneficiary. So if you're like, well, I don't remember my son's tax ID number, great, don't put it in. Even if like I don't remember the day of my child's birth, like I remember that it's like April in 2020. You do not need to put the date. Just give us as much information as you can, but don't sleep on beneficiaries. Like don't skip the beneficiaries section. It is so, so important. So, if you don't have anyone you want to leave it to, you can absolutely put a business, a charity, a foundation in here, and we will make sure it gets to them. Okay, spousal consent, that is only in certain states. If you want your spouse to sign this and you're not in one of those states, that's fine. It's better to get this signed if you than not to, but again, that's only if you're in certain states. And it's also only if you are not leaving your IRA to your spouse. So if you and your spouse have decided that in the event that you pass away, your spouse does not need this money and you're going to give it to your children instead, spouse still has to sign, even if they're in full agreement. Again, only in those states that are communal property or have those laws. So, but if you are making your spouse your beneficiary, no matter what state you're in, this section doesn't matter. Section 7, you're just going to sign. We're your custodian. So you can leave the witness and custodian blank. You just need to sign as the owner. If you are wanting to open up an IRA at USSFCU, you are welcome to call us. Any member of our call center team can absolutely help you. You can ask for the IRA department specifically, and we're happy to help you. But if you're not wanting to make the call, then you can go to Retirement Central. Retirement Central has a lot of options to help you. It is not the end all be all. You're still going to want to reach out to us on a lot of things, but it is great for setting up that initial IRA. So you can go to Retirement Central via our website. It's also in your online banking now, and you can open up that account. You can also manage your account there. And then another really great thing about Retirement Central is the planning tools. So if you're like, well, Madison, you went through this way too fast. Then you can go to planning tools and pretty much everything I've said is on there. So, another great resource for you. But you can visit, that link and get there. And then maximizing your IRA benefits. So time is your greatest asset. And I know that comes with a lot of privilege. Like if you didn't discover IRAs until you were 45, that's fine. Start at 45. That's totally okay. Because every day that you have where your earnings can grow is a day well spent. So start early and contribute regularly. I mentioned that for a long time, I only contributed $50 a paycheck, and that's enough, especially as a start. So contribute what you can when you can. The more regular you make it, the more it's just going to be like, oh, yeah, that money's gone. I never get to see it. It's just gone. And then when you're retired, you're really going to be patting yourself on the back. Take advantage of catch-up contributions if you are somebody who started later, or even if you're not and you just want to be more comfortable. Once you hit 50, if you're maxing it out, bump it up 1,000. That's just a great opportunity. You're going to want to diversify your investments. I know a lot of people in times of economic crisis are really scared of the stock market. If you're already in the stock market, I highly encourage you to stay. As long as you have time, it'll swing back up. But if you're getting close to retirement, you're nervous about the economy, that's when you're going to want to go more into the safe CDs and safer investments. So make sure that you're diversified always. But especially at different times of your life, make sure that you're diversified in a way that benefits you. And then avoid early withdrawals to prevent penalties. I heard of somebody who was taking out their vacation fund from their 401k every single year. And guys, if you're going to do that, it's better to not put it in because they were paying penalties and things and taxes. So there was no benefit to putting it into the 401k in the first place. So once that money is in there, unless if it's an emergency, unless if you really need it, or you're feeling really secure, try to leave it in as long as you can. But small contributions can make a big difference over time. I do just want to throw out, I love running the numbers because it makes me feel really good. So I am just going to give you like one really broad estimated thing. So let's say that you are contributing $165 a month. That's about $150 a paycheck. you would get really close to that 2000 mark where you get that tax savers credit if you qualify. And you have a 10% rate of return. You're talking about after 10 years having $32,900 plus, and 13 of that was interest. So 13,000 of that was money that you didn't have to put in. At 30 years, you're looking at having 340,000, and 280,000 of that was interest. So if you can put the money in, it'll start working for you. I saw a really great quote the other day that said it's easier to make $1 million a month than it is to make $1 million a year. And this is what they're talking about. Having compound interest, having investments, things like that are going to help you make those bigger monies. Another thing that I thought of, or another little tidbit that I want to share, or tip that I want to share with you, is that Roth IRAs make a great gift. So if you want let's say you have for your child's 18th birthday or for their 25th birthday, whatever the case may be, you can help your child open up a Roth IRA, do that initial investment of $50 or $100, whatever the case may be, and then start them growing and teaching them. So that's just something I've seen a couple of times, and I think it's a really, really phenomenal thing. So we are always here to help you. There's my information. Candace Davis is my senior IRA specialist. She handles the vast majority of our transactions. So if you're like, Madison, you did so good. Thank you so much for doing this. I am ready to open up an IRA. Then you're going to want to reach out to Candace, and she will help you with opening that IRA. She will walk you through every step of the way. If she's not available, or if you just have general questions, she's great at answering general questions too. But I can also answer that. Either of us are always super happy to help you. The best way to reach either of us is IRA service at ussfcu.org email, or you're always welcome to call in. You're also welcome to call into the call center, and they'll get you over to us. However you want to reach out, we'll be there. You can also talk to a financial advisor. Michael Shamel is our guy over there, and that's how you can get a hold of him. And then you can learn more at Retirement Central, as I mentioned. A quick tip with Retirement Central is that you do need to allow pop-ups. It does go to a third-party website that we are contracted with. They're extremely safe. It is not a phishing scam. It's somebody that we've vetted and have used for many, many years. And they are regulated. And so you do need to allow pop-ups because you do go to that external website under our umbrella. So visit Retirement Central. It's a phenomenal resource. And then lastly, just our little legal blurb. And I know I mentioned it many times. I am not a tax advisor. I cannot advise. And so make sure that you're reaching out to professionals. It's always good to get 2 or 3 opinions, but we would love to have you have an IRA at USSFCU. So please feel free to reach out and utilize us as much as you need. And then that's it. I'm ready for questions.
Okay. Thank you, Madison, for this great presentation and being here today. So for our first question, if I have a 401k through my employer, can I also open another IRA account?
Yes, and you should. So that's like the best part about IRAs is that you can have, especially if you're starting to like max things out, or even if you're not, if you want that flexibility, you should be opening up a Roth IRA in addition to your other retirement plans. It's going to help you out more in the long run to have multiple. So not only do you want to diversify your investments, you want to diversify your types of accounts. So if you have a 401k, don't let that stop you. Also get an IRA.
And our next question is, how much risk is there with a Roth IRA, or I can't talk, Roth IRA? How much money, or how is the money invested?
So the risk is up to you and the investment is up to you. So I would highly recommend reaching out to Michael Shamel if you're wanting more information on that, because you can go to a financial advisor and you can say, I want to have medium risk. Or I want to have, so the higher the risk, the more opportunity for gain, right? Because otherwise everybody would just do low risk, high gain. And that's unfortunately not the real world. But you can go to him and say, I want high risk, like I'm young, I have plenty of time to be playing with this. then he'll get you in some high risk, high paying investments. That's probably going to be like bigger stocks, things like that. If you say, I want medium risk, then he can go over investment options like hedge funds, or I don't know. Gold is kind of a medium risk. He's qualified. He's got all of his licensure and stuff like that. So just do some research. If you want low risk, in my opinion, the best low risk investments are CDs. They are guaranteed, and we have excellent CDs. We really pride ourselves with being competitive. So feel free to reach out if you're wanting something that's low risk. And yeah, so it's up to you, however you want to handle that. It's going to determine your age, because how close you're to retirement matters. It's going to be affected by, what's going on with the economy, especially if you're just starting out, you're going to want to be really paying attention to what's going on. So there are some options for you.
And our next question is, what about gig workers and retirement planning?
Gig workers, like if you're like an independent contractor type thing. If that's the case, and please correct us in the comments if I'm not answering this right, then at that point you may want to, if you're somebody, my husband's a musician, if he was doing that full time and just gigging all the time, then we would be looking at a SEP IRA probably. But you would definitely want to reach out to a tax advisor, and talk about your options specifically with a tax advisor. It depends on whether or not those gigs are under you making a company out of them. But anybody's allowed to have a Roth and a traditional IRA. So if you're somebody and you're not worried about contributing more than $7,000 or $8,000, depending on your age, I would start with a Roth or a traditional. And then if you're maxing that out and you need more opportunities, then look for more. But if you're just starting out, I highly recommend doing a Roth or a traditional IRA. Getting that funded and then learning more about what's going to help you individually. I feel pretty confident blanket stating that a Roth or traditional IRA is good for everyone. And then if you want to do more, get a good qualified tax advisor. A lot of tax advisors don't necessarily know too much about retirement accounts, so find one that specializes in it if you're wanting to do something like a SEP or a simple IRA.
And our next question is, what's the difference between Roth and traditional?
Great question. There are so many resources online if you want to go over this. We also have a lot of information on Retirement Central, but the biggest one that I would say, like if I had to do it in one point, it's about when you get your tax benefit. So if you want a tax benefit now, you're worried about what tax bracket you're in, things like that, you're going to want a traditional IRA because you get a tax break up front. It lowers your adjusted gross income. If you're not worried about that, and you're wanting just the biggest tax break possible, depending on your age, and how long you want to invest, then I would say get a Roth, because with your Roth IRA, you are going to get that tax benefit when you take the money out, because those earnings that you earned, that in my little scenario where you're doing $165 a month, and after 30 years, $280,000 of that was interest, you never have to pay taxes on that interest. You had to pay taxes on that other, 80,000 when you put it in, but you're never gonna have to pay taxes on all that interest earned. So it's just about when you want that tax benefit and what's gonna save you the most money in taxes. But I would say that's the biggest difference, is when you get that tax break.
And what is the relationship between a financial advisor and a TIAA?
I'm not sure. I think so. A financial advisor is somebody who can help you with like investments and things. I want to say TIAA is just okay. TIAA is I think it's like an insurance a company. So okay, to clarify, I don't know is the short of it. But my understanding is that if a TIAA is like an insurance company or somebody that's selling annuities, things like that, that's just a different realm of investments. A financial advisor is somebody who is going to do, they're going to have access to stocks, CDs, and it depends on your financial advisor. You can get some of them that go really out there. Some of them are going to stick to the more mainstream ones. Some of them are only going to do things like gold. Like they're just a gold investment company. So I'm pretty sure TIAA is just a type of investment, whereas a financial advisor generally covers a few types. But you should check me on that because again, my official stance is I don't know.
Are all Roth IRAs the same? For instance, if I enroll at USFCU or in my employer?
So if you're doing it through your employer, it's not a Roth IRA, it's a 401k. And if your employer offers a Roth option, it's still a Roth 401k. And that's great. Please do that, especially if they're offering a match. You should always take the match because that's 100% return on your investment when they're doing it. So it's different if you're opening up a Roth IRA. So if you're opening up a Roth IRA, it is an IRA, just like a traditional IRA is an IRA. If it's through your employer, it's a 401k. Both good things to have.
Thank you. Why would you choose plowing money into a Roth IRA rather than a 403B or a 470 or 57 plan?
Yeah, so if you have a 403B or those other options, there's several of them. Great. I know like military does TSP. All of those are really, really good options. They're tied to your employer. And so again, please be filling those out. I have never not contributed to my 401k. With everything I know about IRAs, with every trick and everything that I have up my sleeve, I'm still investing in my 401k or 403b or whatever avenue is coming to you. Please still invest in those. The Roth IRA or the traditional IRA is supplementary. And in fact, if you just don't have the budget to do more than what your employer is matching, that's okay. Don't open up an IRA. But if you have anything else to contribute, even if it's just $50, do the IRA in addition to, because it's not tied to your work and you can choose your investment a little bit easier.
Yeah, additionally, Madison, if I may add to this answer, because the reason why I want to dive into it is because I actually do that myself. And my wife, my wife works for the government. I work for the credit union, obviously, and we both contribute to our retirement accounts. I actually have the Roth plan on my end, and my wife has that 457 plan. And the reason why we actually have individuals IRAs and the reason why we contribute to it is for tax purposes. For me, that's solely the main purpose of it. It's so that I can get a little bit of a tax break down the road. Once you hit a different a certain brackets with the IRS, anything that you can that you can do to help you minimize what you're paying Uncle Sam, an IRA will do that for you. So again, that would be my tip as to why I contribute to an IRA outside of my retirement plans that we have. Both my wife and I at work. So that would be what I wanted to add on that part. But again, like Madison said, we encourage everyone. If your employer has a matching plan where they can contribute, they will match up to a certain percentage. Please take advantage of that first. Do that, and then if depending on where you are, what situation you're in, if you want to explore something else, if you're like me, you want to look for as much as you can do in terms of getting a tax break, then come in and join my side. But again, there's many reasons as to why you might want to explore and open an IRA outside of your contributions to your retirement accounts.
Absolutely. That was perfectly said.
Okay, so our next question is, what is the minimum amount you can contribute to a Roth IRA? Can you determine the frequency of how often you want to contribute? For example, monthly, weekly, every 2 weeks, etc.
Yeah, there's no minimum. So if you call me up and you're like, Madison, let's do 50 cents, I'm going to say, Great, let's do it. Are we going to spend more money on the paper and check? Yeah, but that's okay. Like you're getting 50 cents for your retirement. So, no minimums and there's no maximum amounts of time you can contribute. So if you call me every single day for a year, I will talk to you every single day for a year, not on the weekends. Um, but I like to do mine. So we pay our bills monthly. So I just do it monthly. A lot of people do bi-weekly because that's when their checks come in, do bi-weekly. And then a lot of people do once a year. So it doesn't matter if you, some people do it every 6 months. So as often as you want to contribute, whatever's going to encourage you to save the most. It is really hard to watch $7,000 fly into a retirement account that you can't touch. Or that you shouldn't touch, right? Like you can, we talked about that. But so for me, it's just a lot easier to break it down. I call it one of my bills and I do it monthly. But however often you want to do whatever's going to serve you best is great.
Thank you. And to maximize the benefits of having a Roth IRA, would it be the best to contribute to it frequently or on a set schedule?
So technically speaking, that's a great question. Technically speaking, contributing the first day of the year is going to give you the most time to let that grow. However, if I'm sitting there at the first of the year and I only have $3,000 to contribute, but if I do it bi-weekly, I'm going to contribute more than do it bi-weekly. So it's up to you, but technically that right answer is if the first day that you can contribute gives it like, I mean, if you're doing it once a month, that 12th month is going to have less time in there than the first month is what I'm saying. So, but again, whatever's going to get you to save the most money is what you should do.
I am 62 plus years old or plus. If I open a traditional IRA, what is the max I can't talk, contribution amount for the year? Also, can I withdraw from this IRA at any time?
So for a traditional IRA, or Roth, for either Roth or traditional, the max contribution at age 62 is going to be that $8,000. So it's 7,000 plus your catch-up contribution, which is 1,000. So $8,000 total. And yes, because you're over the age of 59 and a half, you're able to withdraw at any time. Again, you're going to want to talk to a tax advisor just to make sure. But yes, you would have full access to it. Like I mentioned, my dad is in his 60s. He opened up a Roth. He's been contributing. He does have full access to that. But he's still contributing. So as long as you have earned income, you can contribute. Now, if you retire in the next few years and you no longer have earned income, you can still have that IRA. You just can't keep contributing. But let's say you retire from your main job and you are working part-time, you can contribute up to whatever you're earning. So if you capped at 8,000. So if you're working part-time and you only earn 6,000 in a year, you can contribute 6,000. But if you are working part-time and you make $20,000 a year, then your contribution max stays the same.
What is your interest rate for a $500 12-month CD?
That is a great question. Do one of my co-presenters have it?
I think Carrie has it. Or not.
No, I'll grab it really quick from their website. These are traditional CDs, right?
For traditional and Roth, the interest rate is the same. Just to
Oh.
throw that out there for everybody. You're good though.
Thanks, Madison. You couldn't have played along. All right. So, and read the question again, Andrea, so I know the terms.
It says, what is your interest rate for $500 for a 12-month CD?
Okay. So I think you need $1,000 to open a CD. The minimum balance is $1,000. So for $1,000, 12-month CD, APY is 3.51%. 24 months goes up to 3.56. 6 months is 3.46.
Thank you so much, Carrie.
I'll throw a link to our rates page in there too. Thanks.
Is there a fee to use for financial advisor to use for the financial advisors? If so, how much would it be?
That is my favorite question because no, there's not. So there's really no reason not to reach out. The way that they get paid is from the investments and it's all sorts of backdoor things. But you as the consumer do not pay anything for a financial advisor. And so please do not feel silly or like you shouldn't or like there's any kind of mystery going into meeting with a financial advisor. They help people all day long. That's their job. They so you don't have to pay anything, you don't have to know anything. You just need to go in and they're there to serve you. So whatever you end up needing, they'll work with you on.
Also to emphasize,
Madison. Oh,
go ahead,
sorry,
Karen.
Eddie. I was just
No,
going to
go ahead.
ask you, Madison, if you could go back to the slide before. So if people wanted Michael's
Oh,
info, they
yes.
could get it. Sorry. Go ahead, Eddie.
Oh,
Sorry
your
about that.
goodness.
No worries. Also, one thing I wanted to mention that Madison, you have so much knowledge. I need to talk to you more often, honestly, because after this presentation, I feel like I should open more, IRAs on my end. You definitely inspire me and all the knowledge that you have. We appreciate it so much. Also, to emphasize that financial advisor, program that we have, whatever happens between the member and the financial advisors is confidential. So we want to emphasize that too. Like, no information will be given to us. None of that will be discussed with us. It's going to be between the member and the financial advisor. So, and as Madison was alluding, during her presentation, while she's giving us the answer to all these great questions as well, is talk to us, talk to financial advisor, let them know what your end goal is. If you want to retire early, if you want to, max out your investments, just talk to them and they will guide you to the right path because as Madison was saying, that's their job and that's the reason why they're licensed and they're professional is because they can give you that advice that you need to go to the next level. So thank you very much, Madison.
Yeah, thanks, Eddie. And also just to kind of continue on that, we want you to make the most money on your investment. You worked so hard for your money. So if that's with us, great. If that's not, that's fine too. That's the benefit of the credit union is that we're here for you. And so I know that when I first started here, I talked to Michael because I really wanted to make sure that before I sent anybody to him that I trusted him and that I thought he really had the members' best interests at heart, and he does. And so we just definitely want you to be able to get what you need to best be set up for success in your future.
And our next question is, if I max out on my 401k, can I still open another IRA?
If you max out on your 401k, then yes, and that is an excellent reason to get a IRA because then you can go and contribute an extra $7,000 to $8,000, right? So I still think you should get an IRA even if you're not maxing out your contribution limits on your 401k. Excuse me, but it's definitely like an absolutely. Now, if you max out your traditional IRA, you've maxed out your IRA option. So you cannot go then and contribute to like if you have a traditional and you max out your traditional, you can't then open up a Roth and contribute to the Roth. So you do have to like IRAs count as one IRA. That contribution limit is for all of your IRAs. But if you max out your 401k, open up an IRA, max that out, then open up an HSA if you can and max that out. And then like there's if you have more money to set up for your future, there are more ways to save. So that's definitely when you're going to want to be talking to a financial advisor because then they can talk to you again because all of this the whole point is to not the whole point but a lot of the reasons that you're wanting to save for your retirement in an IRA instead of just by itself is for these tax breaks and so a financial advisor is going to know the best way around those. So absolutely max out. If you're maxing out your 401k, you should definitely be getting an IRA, max that out, look at HSA options, and talk to a financial advisor.
Thank you so much. And we have another question. What will happen if I open an IRA after 4/15/25?
Then nothing. So that's great. If you open up if you open up after the tax deadline, then you just can't make prior year contributions, which at that point in the year, you're a third of the way through the year or fourth of the way through the year. Like it's 2025. Let's live in the here and now. So So open still, if it's after the tax deadline, still please open up that IRA. Even now, if you're wanting to contribute to your IRA and you don't want to make a prior year contribution, that's totally fine. You do not have to do that. Start saving how you want to save now. That's our only goal, is that you're saving, you're taking care of your future self. But feel free to open up an IRA any day of the week.
Um,
Except on the weekends, right?
Well, on the weekends, you can do it through Retirement Central.
So this question might have already been asked or answered, but I'm going to ask it again. What is the income limit on contributing to a Roth IRA?
That's a great question. It was not asked. You're going to want to talk to a tax advisor about your specific situation, but I can just give you the brief overview. Again, it's tiered, so or like there's a phase out element to it. So and also it's determined on how you file your taxes. So if you're filing, if you're single filing single, it starts at 150,000. So if you make more than 150,000, you're filing single, you're going to start entering that phase out range. So you're going to want to get it with a tax advisor. If you are filing jointly with a spouse, and then that limit starts at 236,000. Those did go up in 2025, so they were lower last year. And again, that's just full. So there's a lot of information about that on the internet, on the IRS website. I actually love the IRS website. It puts a table, it's very clear. So if you are in that max amount range, look it up and also talk to a tax advisor, but that's where it starts.
And what is the difference between employer Roth and an employer traditional?
An employer, so we're talking about 401ks. An employer traditional or an employer Roth is a 401k. It might be one of the other things. But all retirement money is labeled under Roth or traditional. So whether it's in a 401k, 401b, or a 403b, or a TSP, or an IRA, whatever the case may be, it's all labeled under traditional or Roth. Even like with SEP IRAs, there isn't a Roth option, but it's still considered traditional. So just to kind of put that information out as a base point. So the difference between an employer traditional or a 401k traditional is the same, essentially, as a traditional IRA. And an employer Roth is the same as a Roth IRA with a lot of the rules and all that stuff. And that's kind of hard to like get in. We can't get into the details in like this time frame in this setting, because like you have differences between a 401k and an IRA, and then you have differences between Roth and traditional. But ultimately, to try to answer it as simple as possible, a traditional 401k is you get the tax break up front. So if you're contributing to your 401k, and it's traditional funds, that is being taken out of your adjusted gross income. You are not paying taxes on that. If you are contributing Roth funds to your 401k, then you are paying taxes on that. That is part of your adjusted gross income. But when you take it out at retirement or when you need it, then you will not have to traditionally pay taxes on it.
That's
Is
awesome.
there
Another way I was going to say it just so that it helps you, because I know for me that's how it helps me when I think of traditional versus IRA versus Roth, is that I pay taxes. If I do a Roth, I pay taxes up front. So when I go ahead and get and I do the distributions, I don't pay for taxes. If I do traditional, I pay for taxes at the end, depending on what age. And so again, talk to a financial advisor or come and talk to us. We can better guide you and determine what will be the best option for you to look into when you're exploring the different types of IRA. So great questions.
Is there an annual maintenance fee for traditional IRA?
Nope. We don't charge for any of our IRA accounts at USSFCU.
Does RMD apply to employer Roth?
RMDs never apply to any Roth. Because, and again, I mentioned this earlier, but the government wants their piece of the pie. So with traditional, because you'd never paid taxes on it, they eventually want you to pay taxes on it because they want their portion. With a Roth, you already paid taxes, so they don't care. So it doesn't matter if it's in a 401k, if it's in an IRA, if it's a Roth, there's no RMD.
Is 401k the same as traditional? I missed that.
Okay, so a 401k can either be traditional or Roth. That was a good question, by the way. Like I'm glad we're clearing that up. So 401k can either be traditional or Roth. A IRA can either be traditional or Roth. A 401k is through your employer and is typically traditional. Just to throw that out there. Not all employers like offering the Roth option. It's a little bit more complicated. And there's and they get a tax break when they do your match into a traditional. So a 401k can have traditional or Roth, and an IRA can have traditional and Roth. Sorry, I lost the question. Can you ask it one more time?
Yeah. Is a 401k the same as traditional?
Okay, yeah. So no, a 401k is the type of account. Traditional is how the funds are determined or what tax benefit you get. And then an IRA can either be traditional or Roth as well.
And I believe that was the last question for the night.
All
Awesome.
right.
Those
Thank
really were
you.
all great questions. Thank you everyone for asking them.
Well, thank you, Madison, for coming with us and joining us again in another weekly Wednesday webinar. I know we put a little overtime on this one, but like you say, excellent questions, and we really love the engagement. So thank you everyone to stay all the way until the end. This is probably one of the longest webinars that we've done, but it's a very, very important one. So much great information, and as we mentioned at the beginning, this is IRAs is something that there's always changes from time to time. So it is good to be up to date. And most important, if you have any questions, you see their contact information there on your screen. This presentation is going to be shared with everyone as well too. So be on the lookout. And as Madison alluded to at the beginning as well too, we do have a set of everything that we do here. We do record them, and you can have access to them in our website, or you can actually go to our YouTube channel as well, where you'll be able to see the previous webinars where you have Madison as a presenter. And again, she does have a lot of knowledge when it comes to IRA. So again, feel free to reach out to us, and we'll be more than happy to get you connected with Madison if that is something that you want to do on an individual level, or if you want to take advantage of Michael Schimmel at Fellows Financial. He can also assist you too. So again, encourage you to visit our Retirement Central too, ussfcu.org/IRA, and you can get a lot more information there. So again, Madison, thank you. Before we let you go, we do want to invite you again to our weekly Wednesday webinar next week. Carrie, we have an exciting one. Actually, for the first time, we are going to be playing bingo next week. So if you want to come out and be part of the bingo game that we're going to do next week, it's going to be on fraud. So spot the scam before it spots you, and we're going to do a virtual fraud bingo with some cool prizes. Carrie, you want to share what are some of the prizes that we're going to be giving away next week?
Money, money, money. So what's cooler than that, I guess, besides putting that money in an IRA?
Again, we talked about it last week. For those that joined last week, we shared that Eddie recently got promoted, and he got so much money that he doesn't know what to do with it, and we're just giving it away. So again, thank you for staying with us this late. We truly appreciate you. Most important, Madison, thank you so much. We enjoy. You're a delight having you on a weekly Wednesday webinars. We need to make you an official team member of the panelists. So. Again, thank you. Eddie, any final words?
No, that's it pretty much. Thank you, everybody. We have said this before. We want to say it again. Without the attendees, these webinars wouldn't be possible. So thank you very much for your support. For those that have been with us since the beginning, this is season 3 of this weekly Wednesday webinar. So we're just so happy that you have stick with us, you're learning with us, and even the panelists will learn something new every single week with you all. And as Milton alluded to, and I want to emphasize that again, we love the engagement. So the more questions we get, the more excited we get. And just give us your ideas, any thoughts. You see our information, you can contact us directly. But with that being said, thank you very much for your support. And please support us next week as we play bingo together. I went to my local bingo down the street. I've been practicing my skills. So with that being said, Milton, Andrea, Carrie, and of course, Madison, thank you very much for this great evening. Hope everybody has a great evening. I will see you next week at the same
Wait.
channel at the same
We
time.
have one more question.
Uh-oh. Okay. It's a
Sorry.
commitment. Go, Andrea.
Should you invest with your IRA?
100% of the time. Your IRA is doing basically nothing for you if you're not investing it. You will not be keeping up with inflation if you're not investing it. So you'll actually be losing money if you're not investing it. You can be as safe or as risky as you want, but you have to invest it. So many young people, especially right now, we're seeing a huge trend in the industry where people are not realizing that they have to then invest their IRA, and just so much money is being left behind. So if you are contributing, the $165 a month that I mentioned, or $50 a month, that's enough for retirement if you're investing it. It's not enough if you're not investing it. So it's a huge, huge difference. You have to invest, at least be investing in CDs. But yes, invest.
Invest. It sounds like a financial advisor, Madison.
Thanks. Oh, it's not. It's not.
Love
I'm
it.
not a
Thank you all
financial
again.
advisor.
We'll see you next week. Good night, everyone.
Bye, everybody. Take care.